my friends, is a 10-year chart of Dryships, the Epic Short Squeeze that everyone remembers from 2016. But when you look back on this stock, and if you've ever looked at a double or triple leveraged ETF product, what you'll notice is after so many reverse splits, you start to see crazy prices that reflect the ultimate low prices in the stock. As you can see, Dryships traded as low as $1, traded as high as $73 million back in 2011 on an adjusted basis. These little purple dots are the different times that they did reverse splits. But just look at this chart. Now, as crazy as this chart looks, do you want to know where the Epic Short Squeeze was? I mean, really, the huge event? It's not here. It's not here. It's actually right here. It's not even a blip. And look, there wasn't even any volume on a relative basis during this time frame. But this was the epic short squeeze that we're going to focus on next. But I just wanted to give you the broader perspective. Like, how crazy is this, right? An epic melt up short squeeze on a stock, and you can't even see it on the chart. Because although these moves were big, they're still tiny relative to the percent change. Okay, this is percent change is tiny compared to what happened in this tiny little blip right here, and that's what we're going to focus on next, right? From a percentage basis, we can use this to get a sense of the magnitude of the move. So what we saw back here is that Dryships had, in the year of 2016, done 3 reverse splits, a cumulative total of 60 shares being converted into 1. So what do we mean when we say reverse split? In this example, if you were to think of this being full, and if you can think of this cup as holding 300,000 shares of Dryships, on that day they did a reverse split. 25 shares will be converted into 1 share. This doesn't change the valuation of the company. It takes shares out of circulation. It reduces the number of shares that can be traded, and that causes the stock price to go up, but the number of shares you have is reduced. So in this example, on 11th of March in 2016, your 300,000 shares when you came in that morning became 12,000 shares. Okay, so the valuation hasn't changed, but the stock price has now been reversed. It is now going up instead of going down. When you think of a normal stock split, they double the number of shares outstanding. In this example, Dryships did the opposite. They did a reverse stock split. So they're actually taking shares out, not putting shares in. They want the price to go up, not the price to go down. So in this example, you had 300,000 shares on the 11th of March. When you came in the morning, you had 12,000 shares. So the number of shares had dropped and the price of the stock would be higher, but your profit P&L does not change. Then in August, they did a 1-for-4 reverse split. Now your 12,000 shares became 3,000 shares. And then on 1st of November, they did a 15-for-1 reverse split. So now what was 300,000 shares in March was only 200 shares. Now this reverse split, 3 of them over a span of 9 months, created an environment where the float, the number of shares remaining, had shrunk significantly. And a lot of these clever short sellers were not keeping track of the total float. And what ended up happening is they went in to do their typical short trade, but they had no clue because they were not methodical in researching how many shares were outstanding. They were ignoring or sloppy in their research and were completely unaware that when they went in to short the stock, that there actually weren't that many shares left. So they got too big. And what do I always tell people? Stay small. And in Dryships in 2016, we're going to see what happens when you don't stay small. So let's move on over 3 reverse splits in the same year. So this was just crazy, unprecedented. You'd never see the same stock having reverse splits every quarter, unless of course it was a triple leveraged ETF product. And all those products will do something similar to that. So this was a big shocker for most people. The stock had been going sideways for a while. If we go back further, we can get a sense of just how stable the stock was. So really, this is what you'll see in epic short squeezes. You'll see that the stock was trading significantly higher early on, and notice there's no volume in here. You see how that happened? Just virtually non-existent volume. I mean, there is some volume, but it's just tiny. So on an average day, it was lucky if it did 100,000, 200,000, a million shares in a day. And then we came over here. We had just done our third reverse split. This one was converting 15 shares into 1. And then this is where this epic event started. So if we look from here and we go into an hourly chart, what we'll see is that on a Thursday, right after earnings were announced, and they were horrible earnings. And so this is what's so hard for financial analysts to understand. You know, I spent 3 years to get my CFA charter to become effectively an expert on financial analysis. And I can tell you that when this stock lost $7.70 per share, this company was effectively bankrupt. And so the value of this company, the terminal value of this company, was less than 0. So it made a lot of sense to be short this stock or to even short more. But what people didn't understand, that in the process of reducing the total share count by basically converting 60 shares into 1, they had significantly reduced the total number of shares in this company by an incredible amount. And the average short seller who's made a living shorting tanker stocks, they wouldn't have even bothered to check how many shares were outstanding. They would have just done their normal size, whatever that size was. If it was 1 million shares, then they would have just said, I want to short 1 million shares. They wouldn't have asked, how many shares are there left in this company after all these reverse splits? You had people who had shorted this stock and had no idea what trouble they had gotten themselves into. And so what we saw is on the Thursday, basically the stock went up 200%. And people started getting a bit nervous. And then just before the open on Friday, it jumped, another 100%. And then these people started to get phone calls from their brokers, margin calls. They're starting to get nervous. And then what happened was, over the weekend, people probably started to figure out that, holy crap, how many days to cover this stock now? The volume is so small in here. And as you can see, even on Monday, we were up 800%, 900%. There was virtually no volume. No volume at all. So these guys were trying to cover positions, and the fact that there was no volume means what? That means there were no sellers. There were no sellers left. And so the short positions were trying to buy stock, but there just wasn't anyone interested in selling them their stock. Now, part of the reason for that is the stock had plunged so far down that the only people left were speculators who were willing to basically buy the stock for almost nothing, $4 or $5. And these speculators, they're not going to be willing to sell the stock for a 20% return or 100% return. They're looking to make 10 times their money, right? They're looking for 1,000% return. And that would just be some of them. Other ones would want to ride it out and see how crazy it could get. So that's what happens in a short squeeze. Company announces horrible earnings. The stock's supposed to go down. Everyone's expecting the company to collapse. And then a couple little pieces of information come out. One, the Baltic index breaks out and makes a new high on the year above 1,000 points. At the beginning of January of 16, the Baltic Index was only 275, but the week that Dryships was considering bankruptcy and talking to their creditors, the Baltic Index was just breaking above 1,000 for the first time in over a year. This gave creditors some comfort that there was a recovery in the making, and that if they could provide liquidity to Dryships, that they could at least get some of their money back. Otherwise, this stock was going to file bankruptcy. So the Baltic Dry Index is starting to make new highs on the year, and that's encouraging some speculators that perhaps these guys will get a free pass from their lenders, that perhaps the lenders will be willing to compromise and accommodate these guys versus getting $0 back on their money. So as it turns out, over the weekend, it turns out the creditors are willing to take a haircut and provide some flexibility for these guys so they can survive. So people come in on Monday expecting them to announce bankruptcy, but instead they announce that they've come up with new terms. Now all these shorts are thinking, crap, this company is supposed to go to zero. So now they're in trouble, and now they have to try to cover. So between Thursday morning and Monday evening, the stock's up 900%. People are trying to figure out how to cover positions on Monday, and before Tuesday even opens, it's already gapped up 1,200% from 2 days earlier. Stock opens, drops a little bit, and then again takes off. Again, no volume. Very little volume in there. The stock's up 2,000%. Right? That's 20 times. It then drops from up 2,000% all the way to only up 1,400%. So that's a big move back down. But then crazy things happen after hours of trading. Someone finally lost it and basically said, I got to cover this no matter what before the market opens. So this would have been a broker. So I'm just speculating. I don't know. But here's my speculation. The broker got a call from a client, and the client told them, I have bad news. I thought I could come up with the money to cover this position, but I can't, and I'm filing bankruptcy. And so now you own the shares. I don't own them anymore. And so what the broker did went, well, crap. We're going to have to sue the client to recover our losses, but we don't want to be short this thing. And so what the broker did is they said, look, before this market opens, we want this position covered no matter what. And so what they did right here is they paid whatever they had to pay to get this position covered, right? And I don't know how real this volume is that we see in here. At the peak, the stock was up 2,500%. And this is for a stock. That's huge for a stock. In the option world, yeah, it happens every week. But for a stock to do this in a week, this is epic. And there was no reason for this thing to be up here. This was a pure short squeeze. Horrible earnings, expected to go to zero, some rays of light, some potential scenarios where they don't go to zero, and then this thing just launches up. Now, before the market opens, whoever was forced to cover had basically covered everything. So on the open, it immediately gapped down, and from there it was over. Right? So that's what an epic short squeeze looks like. Horrible company, horrible earnings, supposed to go to zero. Instead of going to zero, it goes up 2,500% in the next 5 days. So epic event. Subsequently in 2019, the owner, chairman, CEO of Dryships agreed to take the company private. He used one of his entities where he had funneled all of his earnings from the business and used that entity to basically take over this public company and get it out of the limelight. The company stopped trading from 2019. So that's why you don't see it trading anymore today. So that's why we say Keep an eye on the short positions relative to the kind of volume that happens in the stock, and then also relative to the total float. And if you ever see that number get out of whack, then you may be looking at a scenario where there could be an absolutely huge rally off the back of short positions trying to get out for a massive loss. So that's Dryships.